Let me ask you something. Imagine it's 2014 and you've got 100 Rand in your pocket. You know, back then, that could get you about 8 loaves of bread, maybe with a little change left over. Now, fast forward to today, that exact same 100 Rand, it only gets you 5 loaves. That's not just a feeling, it's a fact. It's called inflation, and it is silently eating away at your savings.
So what if there was a way to fight back against that? Well, that's exactly what we're here to talk about. Welcome to our explainer on investing for beginners. Our goal today is pretty simple. We want to demystify the world of investing and give you 5 clear, totally actionable steps you can use to start building a stronger financial future.
So, here's the game plan for today. First, we're going to dig into exactly why your savings are shrinking. Then we'll walk through a super important pre-investment checklist. After that, we'll explore 2 major investing strategies, show you how to analyze a company for yourself, and finally, we'll cover what might be the most crucial part of all, having the right mindset for success.
All right, let's dive right into section 1. You know, to really get why investing is so important, we have to tackle that bread problem head-on and understand the hidden power of inflation. Okay, now this is where it gets really interesting. We know that money just sitting in a savings account loses its power over time. But look at that other option. If that 100 Rand from 2014 had been invested and earned just an average return, well, it could have grown enough to buy 12 loaves of bread today. I mean, that's the difference right there. It's your money shrinking versus your money actually working for you.
So, how do we get our money working for us? Well, before you jump in and start buying stocks, it's absolutely crucial to get your own financial house in order. And that brings us to section 2. Your pre-investment checklist.
You know, responsible investing starts right here, with 3 things you just can't skip. First things first, attack any high-interest debt. Seriously, if your credit card is charging you 22%, it makes 0 sense to chase a 10% return on an investment. You're just digging a deeper hole. Second, build yourself a safety net. We're talking about an emergency fund with 3 to 6 months of living expenses. This is what stops you from having to sell your investments at the absolute worst time. And third, and this is a big one, only invest money you won't need anytime soon. This is a long-term game.
Okay, so once that solid foundation is in place, now we can talk strategy. So, section 3, growth versus value investing. You can think of these as the 2 main philosophies when it comes to picking where you put your money.
And this breaks down the 2 camps perfectly. On the left, you've got growth investing. These are the high flyers, companies like Amazon or Tesla. They're usually a bit more volatile because they're pouring all their profits back into the business to grow as fast as they can. Here, you're really betting on their future potential. Then, on the right, you have value investing. Think of the stable, established giants like Coca-Cola. They're already profitable right now, and they often share those profits with investors through dividends, which are basically regular cash payments. With these, you're focused on buying a solid company for what it's worth today.
So, let's say you've picked a philosophy that feels right for you. How do you actually find a good company that fits your style? Well, it's time for section 4, how to analyze a company. This is your toolkit for doing your own research and not just, gambling.
The very first tool in your kit is the balance sheet. Now, don't let the name scare you. It's really just a simple snapshot of what a company owns, its assets, and what it owes, its liabilities, on one specific day. That's it. And to make that crystal clear, here's a fantastic analogy. Think of a company's finances as a big cookie jar. The current assets? Those are the cookies right on top that are easy to grab. The liabilities? Well, those are the cookies you've already promised to your friends. You just want to make sure you have more cookies in the jar than you've promised away. Simple, right? And here's a super quick check that anyone can do. You just divide the total current assets, the easy-to-grab cookies, by the total current liabilities. If that number is greater than 1, that's a really good sign. It basically means the company can cover all of its short-term debts.
Okay, next up in the toolkit, the income statement. So if the balance sheet was a snapshot, think of this as the company's report card for the whole year. It shows you how much money it brought in, which is its revenue, and how much it had to spend to make that money.
So how do we grade this report card? Well, here's another really simple calculation for you. You take the operating income, that's the profit from the main business, and divide it by the total revenue, so all the money that came in. If you get a result of 10% or more, that's generally a healthy profit margin. It tells you how good the company is at turning its sales into actual profit.
Our final and, arguably most important document is the cash flow statement. This one is so critical because it cuts through all the accounting jargon to track the actual cash moving in and out of the business. It answers the most important question of all.
Is the company generating real money?
And here's exactly what you want to see. First, positive cash flow from its main business. That's a must-have. Second, you want to see that it's putting some of that cash back into the business to grow for the future. And third, if it pays dividends, you want to know if they're sustainable. Or is the company borrowing money just to pay shareholders? Because that's a big red flag.
Now, I know this can feel like a lot of jargon and numbers, but this quote right here, it really gets to the heart of it. Learning to read these statements isn't just for Wall Street pros. It's a fundamental life skill that empowers you to make your own smart decisions with your own money.
But of course, a company is so much more than just the numbers on a page. And that's where something called qualitative analysis comes in. You have to look beyond the spreadsheet. How strong is the brand? Is the leadership team experienced and trustworthy? And does the company have some kind of competitive advantage, a moat, they call it, that protects it from other companies? Okay, we've covered the what and the how. But honestly, the most important part of all of this is your approach. So let's move to our final section, the mindset for success. This is all about playing the long game.
This is single-handedly the best analogy for market ups and downs I have ever heard. Freaking out when the market has a bad day is like getting angry at a baby for crying. It's just what it does. The market goes up and down in the short term. That's its nature. Your job is not to react to every single cry. And this slide right here shows you the real cost of those emotional reactions. When the Cambridge Analytica scandal hit Facebook, the news was terrifying, and the stock tanked. Panic sellers lost a lot of money, but the long-term investors who trusted their research and just held on, they saw their investment grow over 200% from that low point. It really was just a blip on the long-term radar.
So let's finish up with 3 golden rules to live by. 1. Diversify. Don't bet the farm on one company. A good rule of thumb is no more than 5% of your portfolio in any single stock. 2. Stay informed, yes, but don't get swept up in the daily media hype. And 3, and this is the big one, be patient. It is the most powerful and most underrated skill an investor can possibly have.
We'll leave you with this thought. We started this explainer by looking back 10 years. Now, let's try looking forward. If you apply these principles and start your own journey today, just imagine where you could be in 10 years.